Most financial advice sounds good on paper, but in reality, it often fails because it ignores your habits, emotions, and real-life situations. Generic tips like just save more or cut lattes don't fix the deeper issues holding people back. In this video, we'll break down why most money advice doesn't work, and more importantly, what actually does. Practical strategies that fit your lifestyle and help you build lasting wealth. Stick around, because the truth about money isn't what you've been told. So before we start, make sure to hit the like button and subscribe to my channel. Why generic advice is useless. The most common financial advice often fails because it operates on a one-size-fits-all fallacy. Generic tips such as stop buying lattes or pack your lunch are popular because they're easy to digest and feel actionable. However, they ignore the vast and varied landscape of individual financial realities. For someone earning $200,000 a year, a $5 daily coffee is a rounding error. For someone struggling on a minimum wage, cutting out that coffee might provide a tiny bit of relief, but it won't solve the systemic problem of low income and high living expenses. This type of advice is a distraction, focusing on minor leaks while ignoring the gaping holes in the ship's hull. Financial well-being is deeply personal, influenced by factors like your income, debt, family situation, location, and long-term goals. A 30-year-old single professional with no debt has a completely different financial roadmap than a 45-year-old parent of 3 with a mortgage and student loans. General advice fails to provide a meaningful roadmap for these distinct journeys. It's like a doctor prescribing the same treatment for a broken leg and a common cold. Our brains are not wired for financial discipline. Even when advice is sound, we often fail to follow it. This isn't a failure of intellect, but a failure of our own psychology and behavioral biases. Modern behavioral finance, a field that combines psychology with economics, has shown that humans are not the rational, self-interested agents that traditional economic theory assumes. We are instead governed by a host of cognitive biases that sabotage our best financial intentions. One of the most powerful biases is loss aversion, the tendency to feel the pain of a loss more acutely than the pleasure of an equivalent gain. This bias can lead investors to hold on to losing stocks for too long, hoping they'll recover, and sell winning stocks too early to lock in a small profit, thereby missing out on significant long-term growth. Another major pitfall is overconfidence bias, where people overestimate their own knowledge and skills. The advice that's designed to benefit the advisor. A significant portion of the financial advice available today is not designed to benefit you. It's designed to benefit the person giving it. This conflict of interest is a fundamental flaw in the financial industry. Many financial advisors, or wealth managers, are actually brokers who earn a commission on the products they sell. They are held to a suitability standard, which means they must recommend products that are suitable for your financial situation, but not necessarily the most cost-effective or best option. For example, a broker might recommend a high-fee mutual fund from their own company when a low-cost index fund would provide a better return for the client. The broker makes a commission, but the client's long-term returns are eroded by fees. In contrast, a fiduciary is legally obligated to act in their client's best interest. They are typically fee-only, meaning they are compensated by a flat fee, a percentage of assets under management, or an hourly rate, which removes the incentive to push specific products. Chasing the mirage. The human desire for a shortcut is what fuels the get-rich-quick industry. From speculative meme stocks and cryptocurrency fads to multi-level marketing, MLM, and day trading, the promise is the same: massive returns with minimal effort. This advice is seductive because it offers an escape from the slow, deliberate work of building wealth. However, these are not investment strategies. They are forms of gambling. For every viral story of someone who got rich from a lottery ticket stock, there are thousands of untold stories of people who lost their life savings. The success of these schemes is often based on the greater fool theory, the idea that you can make money from an overpriced asset by selling it to an even greater fool. When the supply of greater fools runs out, the bubble bursts, and the last people in are left holding the bag. Day trading, in particular, is a high-stress, zero-sum game where professional traders with sophisticated tools and algorithms dominate. The foundational principles of wealth building. So, what actually works? The answer is simple, timeless, and surprisingly boring. The foundational principles of personal finance. The core of a healthy financial life is not about outsmarting the market or finding a secret formula. It's about building a solid, disciplined routine. The first step is to create a budget and live below your means. This isn't about deprivation. It's about conscious spending and ensuring that more money is coming in than is going out. Second, you must prioritize debt management, especially high-interest debt like credit card balances. Every dollar spent on interest is a dollar you could have saved or invested. Third, build an emergency fund of 3 to 6 months of living expenses. This acts as a financial safety net, preventing you from going into debt when life inevitably throws a curveball, whether it's a job loss or a medical emergency. Once these fundamentals are in place, the path to building wealth becomes clear. Removing yourself from the equation. The most effective way to overcome the psychological pitfalls of personal finance is to remove yourself from the equation entirely. The most successful people don't rely on willpower, they build systems that work for them. This is where the power of automation comes in. By setting up automatic transfers from your checking account to your savings and investment accounts on payday, you ensure that you pay yourself first without even thinking about it. This simple act bypasses the emotional temptation to spend the money before it's saved. This principle also extends to investing. Instead of trying to time the market or pick individual stocks, a much more reliable and less stressful strategy is dollar cost averaging. By investing a fixed amount of money at regular intervals, e.g. every month, you buy more shares when prices are low and fewer shares when prices are high, effectively smoothing out your cost over time. The importance of personalized, unbiased guidance. While generic advice fails, personalized guidance from the right professional can be invaluable. The key is to find an advisor who operates under a fiduciary standard and is compensated in a way that aligns their interests with yours. A fee-only fiduciary will not make commissions on the products they recommend. Their only incentive is to provide you with the best possible advice for your unique situation. This is particularly important for more complex financial decisions, such as retirement planning, estate planning, or navigating a significant life event like a divorce or inheritance. When seeking an advisor, ask them directly if they are a fiduciary and how they are compensated. Look for credentials like Certified Financial Planner, CFP, which often require a higher ethical standard. From instant gratification to long-term discipline. Ultimately, the most profound reason most financial advice fails is a matter of mindset. We are conditioned by a culture of instant gratification, where we want results now, whether it's a new purchase or a quick investment gain. Financial success, however, is the result of delayed gratification. It requires patience, discipline, and a fundamental shift from seeking a quick fix to embracing a long-term journey. The wealthy aren't wealthy because they found a secret. They are wealthy because they consistently followed a set of proven, boring, and disciplined principles over a long period. They understand that a 10% annual return compounded over 30 years is far more powerful than a 200% gain followed by a 90% loss. To truly succeed, you must stop searching for the next hack and start building a solid foundation. If you like this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.